things worked through. Welcome to the session 5A, provider relief fund audits in the A&A track. If you're not here for the A&A track, the other session is going on in the other session. I'm Carrie Bennett, and I have the pleasure of introducing this session this morning. A couple of housekeeping remarks. Please remember, if you're here for CPEs, back in the corner by the panda is where we have our CPE sign-in sheet, so please sign in there. And then also, as always, please be sure to be respectful of your fellow conference attendees and remember to respect their little traffic light signals. Especially after, well, I guess you can't approach our folks on this particular session, but in other sessions as well. So as I said, I'm Carrie Bennett. I'm here representing Alpha 2. For 40 years, we've been building a comprehensive rules engine for billing and coding guidelines to make sure that, one thing I'm hearing a lot from our providers this week, and certainly experienced when I work on the provider side, is denial and denial prevention, right? And so I believe the biggest key to a sustainable revenue cycle is a great denial prevention model. And that's really what we focus on and why I'm proud to be here at Alpha 2. So if you have any questions about that, or if you're interested in winning a flat screen TV, we have that at our booth. So please stop by and drop your business card there. So I have the pleasure to introduce our two speakers who are here via Zoom. I'll start with Mary Antonetti. She's a partner in the firm. So sorry, they're with Markham LLC. She is a partner in the firm's New Haven office. She specializes in tax compliance and consulting services to not-for-profit and healthcare organizations. She has 30 years of public accounting experience with national and international firms, and her extensive experience includes healthcare and other tax-exempt organizations and their not-for-profit affiliates, including higher education institutions, NGOs, hospital systems, title holding companies, official Catholic directory entities, and private foundations. So welcome, Mary. We also have with us Frank Maselli. He is also a partner in the firm, and he's in the firm's Hartford, Connecticut office. He's the leader of assurance for Markham's National Healthcare Industry Group. They are the leader of the New England Healthcare Industry Group, and he's a senior, he is the leader of the New England Healthcare Industry Group and a senior member of the not-for-profit industry group. With over 20 years of experience, his clients include hospitals, nursing homes, and senior living communities, home health and hospice agencies, community health centers, organizations serving the developmentally disabled, behavioral healthcare organizations, trade organizations, foundations, and others within the not-for-profit and healthcare industry. So please welcome me please join me in welcoming these two wonderful folks for our panel this morning.
Thank you so much. I'm assuming everybody can hear us? Okay, great. Mary's going to share our slides, so I'll wait for those to be brought up and then we'll get going.
We're having a little technical difficulty because I can't share the slides. So is there a way you guys can allow us to share the slides?
For the record, me and Mary have been logged on since 9 o'clock, so I take no ownership over these technical difficulties. Sorry about that, everyone.
You should be able to share it out.
Okay. Perfect.
Okay, great. Well, I'll just kick us off and I'll dish it over to Mary. We've already been introduced, so I just want to thank you for joining us. We have a legal disclaimer here. I won't read it for you. I'll just point it out that obviously this is just a presentation put together with some general facts, circumstances, and based on a program with rules and regulations that have been changing and swinging back and forth like a pendulum for the past 12 months or so. So any particular situation would obviously need you to reach out to your own accountant or advisor or Markham LLP to look at the specific facts and circumstances. I also want to just give you a general kind of disclaimer here or background on the presentation. I think we were asked to give this presentation about 3 or 4 months ago. And at that point, we fully expected that by now you would have gone into the portal on January 15th, completed your reporting by February 15th for the HHS provider relief funds. And now we would be talking about audit risks and how to utilize the the remaining funds that you didn't claim for that first 12-month period. Excuse me. We all know that that did not happen. We're still waiting guidance. There's still many questions to be that are unknown at this point. One of the things we did just to round out the hour and give you as much information we can, we're filling some of the time with employee retention tax credit discussion. That'll be pretty brief. Then we'll go into the provider relief funds, and I'll talk a little bit about what we actually know at this point. And then Mary will finish up with some words about PPP loans. So at that point, if you don't have a PPP loan or not interested, you could kind of bow out of the presentation at that time. So with that, I will turn it over to you, Mary, to start our first few slides.
Thanks, Frank. And as Frank mentioned, and I do think this is key, when we originally were asked to do this presentation, we all anticipated that the Provider Relief Fund portal would have opened up and we would have had a set of guidance to put out and tell you about. And because we didn't have that, we basically made this presentation around what our clients are asking. And these are very, very, very common things that we are dealing with on a daily basis. So we feel that if our clients are dealing with them, many of your organizations are probably dealing with them too. One thing that we've seen is that you can see from this graphic, there's a lot of money swirling around. There's people taking PPP loans, there's people with employee retention credits, there's HHS money, there's state money, there's a whole bunch of money that's all swirling around. And what we're going to focus on a lot throughout this presentation is you can only use the cost once, or you could only use the lost revenue once. So it's really imperative for your organizations that you're looking and tracking this money and figuring out what bucket you're putting each of the money into. Because at the end of the day, you obviously want to maximize as much of it as you can and give as little of it as you can back. But you also want to make sure that you're doing it with the proper due diligence. Oop, went too far. Throughout this presentation, we've kind of put in two different things. One, audit alert. The other one is an action item. So the audit alerts are things that, based on our guidance and our discussions with attorneys and bankers and different governmental officials, that we think that this is good, prudent stuff that you want to have in your files and you want to know about to be prepared for an audit of whatever program we're talking about. An action item is something you have to do. So something you should do now or you're going to have to do in the near future. And we just sort of wanted to highlight for you that this is something that can still be going on. So first, the employee retention credit. And the reason why I bring up the employee retention credit is because there's money in the system today. And this money will be in the system from now through the end of 2021. And I think this is important. And what we're seeing with a lot of our clients is that maybe you weren't behind. A lot of census is down, but maybe you're not really behind in cash because there's been a lot of money in the system, or there's been a lot of rate adjustments where perhaps you got paid for COVID patients at a higher rate. But now you're looking prospectively into going forward into 2021, and you're saying, well, if that money doesn't continue, where's my revenue going to be? So this might be a provision that maybe it doesn't apply today, but maybe it will apply in Q2 or Q3 of 2021 or Q4 of 2021. So I just want you to be aware of it because it's something to continue to look at on a quarterly basis. So the employee retention credit was actually put into the law in 2020, but it was enhanced by the Omnibus Act at the end of 2020, the December Act. Basically, to be an eligible employer, you have to meet one of two tests. It is an or test, so you have to do one or the other. You have to be an employer that has suffered a complete or partial shutdown due to a governmental order, or an employer who suffered a significant decline in gross receipts. Now, the shutdown due to governmental order, that's an interesting one because that is something that may be going away. A full or partial shutdown, obviously, restaurants that were totally shut down, it's a full shutdown. Restaurants that gave takeout, that's a partial shutdown. Those are easy examples. But when you take that into the healthcare arena, there are examples of shutdowns. We have some organizations that may have had people coming into facilities and that part was shut down because there was a a law that was put into place that said you can't have that type of service. You can't have outside people coming in to do those types of services. So they lost certain revenue streams. There are other laws out there that say that you basically can't operate with 3 beds in a room. You have to reduce your beds, which would reduce your ability to operate at full capacity. Those laws are all going to be very specific to wherever you are in the country, or whatever town you are in, or whatever district you are in, because there's a whole bunch of governmental orders out there. So what you need to do is, if you feel that you have been hindered by a government order, you need to print out that order and you need to know the dates of it. So basically, the 2020 and 2021 credits are slightly different, but mostly the same. Let me step back 1 minute and make a point here. This credit is a credit about payroll taxes. It is a refundable credit. So what does that mean? So a credit basically means you're going to reduce your tax liability. A refundable credit means if the credit is more than your tax liability, the IRS is going to give you money back. So it basically means you could get more money back than you owe to the government. That's what makes it a great credit. It was an ingenious system. It is a payroll tax credit. So if your organization is a not-for-profit organization, you're still eligible because they didn't make it an income tax credit, which would have blocked out not-for-profit organizations. So basically what it means is, and I'll give you a simple example. Say everyone makes $40,000 a year, so they make $10,000 a quarter. Say you have 10 employees. So if you have 10 employees making $10,000 a quarter, that's $1 million. No, it's $100,000. So if you get a credit of 70% of $100,000, you're eligible for a 70% credit. So your payroll taxes may not be $70,000 on those wages, but that's how much your credit is, and that's how much money you could get back. So to be eligible for 2021, you need to determine whether you're a large or a small employer. I'll go through that in a moment, but a large employer is 500 employees. You also need to determine whether you are subject to a full or partial shutdown or have a 20% decline in gross receipts in any quarter in 2021 or the immediately preceding quarter, which basically means if you had a gross receipts reduction in the last quarter of 2020, then you would qualify for the first quarter of 2021. If you have a gross receipts reduction in 2021, the first quarter, then basically you qualify in the first quarter and potentially the second quarter. There's not a lot of guidance out there on whether you can switch back and forth between using the prior quarter or the current quarter, but we believe at this point in time that you can. The credit is up to 70% of wages up to $10,000 per person. So obviously a highly paid person is going to get to $10,000 in a quarter much faster than an employee who makes less money. So if a person makes under $10,000, you're just going to get a credit of up to 70% of whatever that employee makes. The catch on this credit is in 2020, you couldn't get an employee retention credit if you also took a PPP loan. The definition of large employer was also 100 employees. So a lot of people just didn't take this credit. What they allow you to do now is if you were eligible and didn't take it because of a PPP loan, you can go back and amend payroll tax returns. And you can go back and get this credit from last year if it applied. Last year was not as lucrative a credit. The gross receipts reduction was 50%, and you only got it till you rose to 80%. So, or you were back to a 20% reduction or 80% of your gross receipts. So many employers didn't really, in the healthcare field, didn't really get to the 50% deduction. The credit was also a one-time credit. So you got up to 50% of $10,000 or $5,000 per person. Whereas in 2021, you can get up to $7,000 per person per quarter, which really could add up. So why does it matter if you're a large employer? And it's interesting because the definition is large employer or non-large employer. If you are not a large employer, then you are eligible to take the credit for all employees, whether they are working or not working. So that would be employees doing their regular job, employees that you continue to pay that are doing a different job, but you just didn't want to lay them off, so you gave them something to do. If you are a large employer, then you are deemed to only get the credit for people who you are paying not to work. So that's why last year with the 100-person cutoff, and most people in healthcare were not paying people not to work. Alternatively, you were trying to get people to work. It wasn't really necessarily something that applied, but this year it applies. One catch is aggregation rules. There are aggregation rules. They are a different set of aggregation rules than the PPP loans. But what that means is that if you have multiple entities, somebody's going to have to help you evaluate the ownership structure to determine whether you have to add them all together for purposes of the employee count and the gross receipts test, or segregate them. That honestly could be a good thing and a bad thing, right? If you aggregate all your entities because you meet the aggregation rules and you're under 500 employees and you get to 20% gross receipts across the board, you would get a credit in all your entities, even if that one individual entity did not lose 20%. So it's an all or nothing aggregation approach. So this is just sort of a flow chart, which kind of walks you through what I just said. You start at the top. Did you have a 20% reduction in gross receipts? Yes or no? Did you have a full or partial shutdown? Yes or no? That gets you to the first catch of whether you're an eligible employer or whether you are eligible for the credit. Then you get to the fact of, are you a large employer or a small employer, and do you meet those requirements? And then you get to the next level and you calculate the credit. Action item, how do you claim the credit? So 2020, you could go back and amend tax returns. Obviously, your accounting firm or someone like Markham could help you do it. However, I've been told that it's probably easiest to amend a tax return with your payroll tax provider because they can do it electronically, which is generally getting people quicker refunds. The problem with paper filing these days is the IRS is woefully behind in opening its mail. So they're a little behind in processing paper claims. But obviously, your accounting firm or somebody else can help you do that. For 2021, you actually have two different options. Well, three different options. One is to stop making your payroll tax deposits now. To be honest, most of my clients have not gone in this option. Most of the healthcare organizations are still operating, so they would like to take the credit if they're eligible for it, but it's not as if they need cash today. The thought behind this credit was that if you allowed people to stop making their payroll tax deposits, you were allowing them to keep cash they had on hand that they owed the government, and it was the quickest mechanism to get cash into people's hands quickly. The second option is to wait till the end of the quarter and to calculate the credit. Now, if you've already filed your first quarter payroll tax returns and you didn't take it, once again, you can go back and amend, not a problem. So you could go and you could calculate the credit. And then there's sort of two options there. A lot of people are just saying, okay, now I know how much the money is. And when I go into my second quarter, I'm going to start reducing my payroll tax deposits in the second quarter up to the amount of money of the credit that I know the government owes me. Because it's sort of like you just have this carryover amount of cash. Alternatively, you could just request a refund from the government, and the government will just send you a check. So how do you substantiate it? Audit alert here. You're going to have to keep all your documentation. If you were subject to a full or partial shutdown, you're really going to need to make sure you print out the orders, email yourself the orders, take screenshots of the orders, have those orders specifically done. You're also going to need to justify your decline in gross receipts. I know a very common question is, well, what about all the provider relief funding? Those will count as gross receipts. That is going to be revenue on your tax return. The question really gets to the timing of it when you're looking at a quarter in 2021 over 2019 or 2020 over 2019. So I think it's going to depend on how you have booked it for your financial statement purposes when you have booked those different revenues. Other things, I mean, these are just different payroll records that you should obviously keep. Moving off the employee retention credit, I'm going to hand it over to Frank, who's going to talk about the provider relief funding.
Thank you, Mary. You could go to the next slide. So the first thing, not necessarily provider relief fund related, but if you are not aware, the sequester has been suspended through the end of 2021. So the only caveat there is, make sure that your billing systems have been adjusted and you're not leaving a whole bunch of, 2% hanging credits sitting in your AR that actually belong as income on your income statement. Next slide, please. So action item, if you haven't already done it, the portal is open for registration. I think it takes about 5 minutes to register. At least you get in the system. But the big unknown is it was supposed to open for reporting on January 15th and close for reporting on February 15th. That has not happened, obviously. And at this point, now we're in May. We're going to get to June pretty quick here. And my speculation only, you're going to end up probably reporting the full 18 months. And who knows, maybe they'll give you more time from the end of June 30. The pandemic is still not over. Who knows what happens with the summer and if enough people get vaccinated and all that stuff. So at this point, it is unknown, but you should register. This is a lot of things hinge off of this report, which I'll get into later on. But, one of the biggest things is single audits. And I know most of the folks in this audience, if you're a hospital, you probably are going to have to get a single audit and you may not have had one before. And you're asking your auditors, hey, how do I prepare for it? And we're saying, we don't know yet because we don't have the information. And the reason we don't have the information is this reporting portal is not open. So moving on from that, the reporting levels, this is one thing I hope we will see a change in. I don't know if we will, but the reporting levels, anything under $10,000, you don't have to report. I think that threshold's a little low when you think of all the dollars that were distributed. But for now, between 10,000 and $500,000, you have to report two broad categories, G&A and other healthcare related expenses. And then if you're above that 500,000, which many of my clients are, you're reporting still within those two broad categories, but there's a breakdown of subcategories. Next slide, please. So the breakdown is as follows. Pretty broad categories, but mortgage, rent, insurance, personnel, fringe benefits, lease payments, utilities, and other. And of course, the catch-all other can be a lot of different things. Next slide. And the healthcare related supplies, information, technology, equipment, facilities. And again, there's an other on this slide as well. So the order of reporting is first your COVID related expenses. Now, if you've read through the FAQs as much as Mary and I have, you probably have noticed that expenses attributable to coronavirus is a recurring theme of a terminology that's used throughout, as well as not reimbursed by another source. So through all these slides and all these categories and all this reporting, that is the overriding theme. Mary mentioned the no double dipping, and they add in here, you have to somehow pin it to the coronavirus or to the pandemic rather. So once you've reported all your your expenses, then you flip over to the lost revenue section. And ideally, I think it's easier to kind of show that, here's the expense, here's, you can substantiate the expense through invoice or payroll records, and then you're done. But if you can't, which I think a lot of providers can't because, there was funding coming from other sources, then you flip over to the lost revenue. And I always have been caveating this whole time, they are asking in the forms, or at least they had indicated that they're asking, what else have you gotten in terms of, PPP, state funding, et cetera. So I don't know how they're going to count that or view that when they code a lost revenue, but I would say just be careful. Next slide, please. So COVID expenses, can come in a variety of forms. This really, could be labeled personnel type expenses. So it could be direct employees, which are full-time or part-time, contracted labor, temporary workers, et cetera. Allowable expenses, here's some examples here, but some broad examples. Now here's another term, incremental unreimbursed amounts. So, you may not be able to pin it directly to the coronavirus. I think of kind of direct expenses and indirect expenses. But if you could prove that the expense was additional this year and it's because of the pandemic, that would be kind of an allowable expense. Now, they did, when you're looking at your salaries expenses that you're claiming, they did set a limit. So, the terms and conditions state that you can't pay over this threshold with these funds. It doesn't mean you can't pay somebody over this threshold. You just can't claim that with federal funds. So, I was going to go into this before and I didn't want to step on this slide, but, I think the payroll and time, when we're talking about personnel, I think there's a lot of time there that if you're able to capture it, and it's tough because these rules were being made as time goes on and these FAQs, keep coming out. And here we are over 12 months after getting the first payment. But I think there was a lot of time that hopefully is able to be captured that was spent preparing for the coronavirus and the pandemic, preparing, your organization's response to it. Now you need to have appropriate time records and submit upon request. You're not submitting it with the application to our knowledge, but if you can, I think this is a big area that just from talking to my clients, it's hard to capture, but I think there's a lot of time and resources that were spent preparing for the pandemic. When just all sorts of things, just from people walking in your front door to, the maintenance and housekeeping and what employees are doing and what PPE and just planning for all that stuff, not the actual, expenditures for those, but the time and resources you spent. So I think this is a big area that providers should focus on and try to create those records, as well as you can. You can't just create them out of thin air, but hopefully you have some method for being able to capture that. So here are some of the things, that we saw, providers hiring, hiring bonus, hero pay, retention payments. I know some providers that were paying extra to folks who normally would just be per diem part-time so that they would not work in any other facilities. So you didn't have that kind of cross-pollination of infection, if you will. Childcare, transportation, temporary housing. These are just some of the categories. You almost need to go through, in my opinion, what I've been telling my clients is, go through kind of a brainstorming session of, go relive as much as you could tolerate it, relive the last year and think of all the things that you did to respond to the pandemic and translate that into dollars and cents, because I guarantee there was a lot of resources that can be translated into dollars and cents. So outsourced services, I think that's kind of self-explanatory, but, food, patient nutrition, facility management, laundering, disinfection, anti-contamination. I think my providers that I work with spent a ton of money on that. So, make sure you're capturing that, dig into your maintenance, expense accounts, see what you find in there, compare it to last year. Anything you could do to start seeing these dollars pop, that's what I would be doing. So on the tax side, I'm actually, Mary, I don't know if you want to jump in. You're the tax person here. So I defer to you on this slide.
It was funny when this popped up. I thought, let's see what he's going to say. So it is interesting. There is a FAQ out there that says that taxes imposed on provider relief funds are an eligible expense for the provider relief fund, which is sort of interesting in and of itself, because you would have kept more money if they just made it non-taxable. But what they have not discussed, and this is really key, is many nursing home systems some of them are not-for-profit, so you would just not benefit from this. But the for-profit entities that are operating in a partnership structure, I know that has been a very common question, because if the taxes aren't actually paid at the entity level, they're paid at the individual level, are they going to allow for distributions out of the partnership in order to pay the tax on that amount of money? And at this point in time, we do not know. We don't know if that's going to be an eligible expense, but that could be a large expense that hopefully we'll get clarification on before you have to perhaps give money back. You know, if you had other justification for keeping your money, it's not going to be that big of a deal, but we're hoping that there'll be some additional insight into it before you would have to make the decision to give the money back. Because if this money becomes taxable at, say, if you have net income in your entity and it's taxable at perhaps a 25 to 30% tax rate, then you know that's a lot of money that somebody's going to have to pay, and we're waiting for guidance on that. So, moving off tax.
Thanks, Mary. Interest earned on provider relief funds. So if you do have this money parked in an interest-bearing account, you should be tracking that. You can use that interest for the same purposes that the underlying funds are allowed to be used on. I'm not sure how big this is for providers with interest rates being so low. Something tells me that if it is making any interest, it's probably de minimis, but you know, you still want to track it. There was no caveat to my knowledge of carving out saying, well, if you made less than X, then you don't need to worry about it. So, you know, take a peek at that and make sure that you're in compliance on that end as well.
And I believe that provision was probably put in because it gets to sort of the tax exempt bond rules where there's this big fear by the government that you're going to get money for tax exempt bonds and then invest it and make more money and only use part of it for what you're supposed to. So I think this was just basically saying, if you took that money and you invested it and you made money, that's fine, but we're going to hold all that money accountable. That it usually gets to, that's the issue the government has with those type of programs.
Right, exactly. On to the next slide, capital equipment. You know, I think the FAQs are somewhat conflicting here because you have one set of FAQs that says you can use the funds and can be fully utilized for capital equipment. Again, the recurring theme directly related to prevent, prepare, and respond to the coronavirus. But then there's other FAQs out there that still say you can only use the annual depreciation. So I don't, in my mind, you got two sets of FAQs, one in November, one in December of last year. And, you know, I don't know how many providers this actually pertains to. I did have some providers that did spend some money on capital and were looking into this, but at the end of the day, I think they decided to not claim it because they weren't comfortable with being able to make the case that it was directly related to prevent, prepare, and respond. But, you know, HVAC systems and things of that nature come to mind, you know, when I think, or any other infection control type of heavy equipment that you may have, you know, you could look to that area. So if, you know, things parked on your balance sheet and fixed assets, you may want to look there as well. So overhead, if you do have a parent company in place, which I know a lot of systems do, you can claim some of that cost, but again, it needs to be attributable to the coronavirus and not reimbursed by another source. So your normal management fee, if you're allocating that down from the parent, if that's kind of the same year over year and the parent didn't have excessive additional costs, then I'd be careful on this one. But you would think that the parent probably, you know, the executive level folks probably spend a lot of time, again, preparing and for the coronavirus. So if you can capture that and then identify what portion of that time is being allocated down to the subsidiary that received the provider relief funds, then I would think you could claim that based upon the FAQs. But again, the devil's in the details and the documentation. So lost revenue, this has been a fun one to follow. If you remember the first set of terms and conditions that you either attested to agreeing to, or you kept the money for longer than 60 days and were deemed to have agreed to it. Sorry, my screen just went blank here. I didn't think that would happen with the presentation. Of course. Okay. So anyways, the first set of terms and conditions basically said, any reasonable method could be used to estimate lost revenue. Then in the fall, I think in September, maybe not the fall, maybe it was still late summer. It was very clearly laid out that it's current year versus prior year. Now we've kind of gone back to the first definition with some caveats. So I'll go through this, but the first option is the easiest one. I think the one that's gonna get you less questions if it ever were to come to an audit, but comparing your actual patient care revenue and patient care revenue, I think is important to distinguish here because, this is the argument I would make if I had a PPP loan that was forgiven. Well, that's not patient care revenue. So if you compare patient care revenue year over year, and there's a shortfall, then that's option one. And you're reporting this by quarter. The second one, which, in September, this option went away and now it's back with some stipulations, is the difference between your budgeted 2020 revenue and your actual patient revenue. Now, the budget must have been established and approved by March 27th. So if that's not the case, I don't know if I would go this route because it clearly says it, must have been established and approved, and you need an attestation from a CEO, CFO, or similar executive level person affirming that the budget was approved and established. So, there's some personal risk there too. You'd want to make sure that you have documentation, for the nonprofits or even for-profits, if you have board minutes, emails, something where there was a formal approval before that magic date. That's what I would want before I'd sign my name to the dotted line on that one. And then option three brings back the kind of any reasonable alternative method. And I've heard a lot of alternative methods that sound really reasonable from my clients, because things can happen with payer shifts and things of that nature where maybe your net revenue didn't go down that much, but maybe you did turn away some volume that you couldn't take on and things of that nature. Now, I'm not advocating for this method because it clearly says using this method has an increased likelihood of an audit, but I do know some providers out there that feel very strongly that their method that they want to use is supportable and reasonable. If it comes to going this route or returning the money, this is definitely an option to consider. You can go lost revenue into this 6-month period that we're already in here. And it would be comparing the 19 to 2021 if you're going the actual route, or the budgeted 2020 to the 2021 actual if you're going the budgeted route. So, if you don't have enough expenses within the 18-month period and you don't have enough lost revenues in the first 12-month period, you can do lost revenues in the last 6-month period. Some of the details here, and we got our little audit alert tag here, total revenue, net charges from patient care related sources. So even if you're not claiming lost revenue, they want this information. It should be pretty easy to take this out of your accounting records and support it with your accounting records. Non-financial data, same thing. They're asking for this. All this information is requested on a quarterly basis. And again, we have our little audit alert sticker there. And then supporting documentation. So no external documentation is required to our knowledge at the time that you're filing this. For providers who received over $500,000, there are some supporting worksheets that will be included. And I thought this was very, very interesting in the FAQs, as they say the original documentation should be maintained for 3 years after the date of the final expenditure report. So for those of you out there, that this time clock has not started yet because the expenditure report has not been submitted. But again, I don't think 3 years is a long time at all for these funds to be audited. I'm not saying that you shouldn't be prepared for an audit, but I would think the likelihood if you've gotten less than the $500,000 certainly, and there's some hospital systems that got a lot of dollars, so I would think those would get the focus first before the smaller dollars. But but you never know. They may be doing some random sampling and things of that nature. But once you file a report after 3 years, you do not need to maintain the documentation. And at that point, I would think that, you know, your risk of audit goes down. Okay, so single audit. If you do have a fiscal year that does not coincide with the calendar year, you did not report any of your provider relief funds, or hopefully you didn't. This notice came out kind of late in the year, so you may have already done it if you were June 30 year end. But provider relief funds did not go on your schedule of expenditures for any year ends before 12/31/2020. Now, I have a bunch of 12/31/2020 audits that need to be done on these provider relief funds, and we are still waiting for information. Some of the things we are going to be looking at are activities and allowable costs. So basically, the expenses that you charge to the coronavirus, to the provider relief fund rather, attributable to the coronavirus, and your lost revenues calculation, and your reporting. And the reporting is the big part, because we're expected to test, and we were supposed to get guidance February 1st, which was 2 weeks roughly after the reporting portal was supposed to open. We were supposed to get guidance on which aspects of the reporting we were supposed to focus on in our audit. We have not gotten that. I've been looking daily, sometimes more than twice a day, to find this information, because again, I have audits that need to be done. In addition, if you're a for-profit provider and you receive more than $750,000, you are likely going to need a single audit as well. So a whole, population of providers who aren't used to compliance audits, at least from this standpoint, are going to have to do this. We keep getting questions on what do I need to have, what do I need to keep for this? Basically keep your records supporting your expenses that you're claiming and your lost revenue calculations. That is the best thing I could tell folks at this point. Keep a binder of your invoices or an electronic file, support, including invoices, time records, anything you have that supports those expenses, because I think that's what we will be looking at as auditors, to be able to sign the opinion, the necessary compliance opinions and reporting that you need to have, and not have any findings. So with that, I will turn it back to Mary for the PPP section.
Thanks, Frank. I agree with Frank. It's an interesting scenario where we literally check these sites daily, several times a day, to try to figure out all the updated guidance on all of this. I think what people have to keep in mind is there was a lot of laws that were passed really quickly, so the underlying regulations still need to be written. In the middle of that, you had a change in administration, which meant, I believe what probably happened with the HHS portal is that it was set to go, and on the end of December, they changed the law that changed basically the definition of lost revenue. Thus, what they had written to open as a portal, assuming they had it written, was no longer good. And then immediately after that, you changed administration and you lost the head of HHS. So I think that's probably where a lot of the hiccups are. So I do tend to agree with Frank. I think there's going to be one reporting. The latest guidance we get out in April basically just confirmed that you're going to have through the end of June to spend the money, and you'll have to give money back if you don't spend it. One interesting point, and I think this kind of bookends between the employee retention credit and the PPP, which are all employee-based programs. So they were all designed to basically supplement the unemployment system and to keep you having your employees employed. You will note in the HHS, they specifically spiked out like temporary labor and contracted services and those type of things, because those type of programs, we had a lot of questions are you're not eligible to use any of those costs for PPP or ERC. So I think it is a definite way to help out the healthcare organizations. So the first thing on PPP loans, I'm not going to go through like who qualifies, who doesn't qualify, because most of you have either gotten loans or haven't gotten loans. What I want to do is focus on what do you have to do? Like, how do you apply for forgiveness? What do you have to keep? Like, what are the different interplays with different things? That's what I'm going to focus on in these next few slides. So the first one here right now is just this caveat that basically says, when the law was passed, the forgiveness of debt income, which is normally taxable, is not taxable. Then the IRS came out and noticed 2020-32 and said, okay, if the income isn't taxable, then the expenses aren't deductible. And then people were like, well, that's not what we meant. So the Omnibus Act at the end of December fixed that law. And now the expenses are fully deductible. I want to caveat that. It's not fully deductible in every state. Depending on how your state complies with federal law, some automatically comply. Some of them have a fixed date conformity, which basically says as of X date, we're going to comply with federal law. Some of them have a rolling conformity, so they'll update their law every year, and some of them opt in and out of provisions. Guidance is continually coming out, so you could run into a situation where the income is taxable, tax exempt from the federal government, but taxable in the state. Also, it's a weird timing and it's a technical nuance, but if you're operating in a partnership structure, depending on this concept of basis, which would allow you to take a loss on your individual tax return, if your organization lost money and you don't have this loan forgiveness and you don't have basis, you may not get the current benefit of that loss. You won't lose it, it'll come next year, but there is a timing difference on some technical provisions with the deductibility and the timing of forgiveness. Other stuff to know. So the covered period is now between 8 and 24 weeks. You can select any periods between 8 and 24 weeks. There is a simplified loan application if you make under $150,000. There is also a shorter application and a longer application. One thing that I've had a discussion with several of my clients is if you've gotten over $2 million in PPP loans, you may be able to submit the shorter application, but keep in mind, you're going to need all the information in the long application because that's going to get audited and they're going to want to see it. So, you know, if you submit the shorter one, that's fine, but make sure you've kind of completed the longer one so you know everything that has to go into it. The interaction of the ERTC and the PPP, as I said, originally you could not get both. Then it went to you could get both until you claimed loan forgiveness. Now you can get both. You just can't use the same wages. So what we envision happening is, for example, let's say you got a PPP loan too, and you'll take those first wages in the beginning of January and you'll use it for ERC. Then you'll carve out the rest of the quarter for PPP. Then you'll flip back in quarter two, pull out some weeks to maximize the ERC. Then you'll go to PPP again, and you'll go back and forth so you maximize both. So one question that comes up and it says, wait a minute, I now think I'm eligible for the employee retention tax credit last year, but I already applied for loan forgiveness. So if you have already applied for loan forgiveness on your first round PPP loan, at this point in time, it is an open question with the government as to whether they will let you amend a tax return to take the employee retention credit. The problem is a lot of people early on submitted their loan forgiveness applications and just put all the costs on to show to the government they spent more than they needed. So they definitely got forgiveness. The problem is now the SBA says you've used those costs with the PPP loan. And will they let you say, well, clearly I didn't need all those costs, so I can take those costs and use them for the employee retention credit. If you haven't sought forgiveness, you can definitely take a credit in 2020 and take the PPP loan. Once again, if they change the law that makes it favorable and you can go back, you have 3 years to go back and amend the payroll tax return, so you have time. There was an EIDL loan. I'm not sure many of you got that, but that was that $10,000. If you got that, that was originally supposed to reduce your PPP loan forgiveness. That is no longer going to do that. So that's great news. If you are not-for-profit entities, they did make it a little easier and you can do your employee count by physical location. So then that way there's no aggregation in not-for-profits. So some organizations that maybe thought they didn't qualify now qualify. If you did not get a round one loan and you are a PPP, and you are a not-for-profit organization, you can go back and still apply for a round one loan, which doesn't mean you need the reduction in gross receipts. You just have to meet the requirements of the original PPP loan. because they make you take the first draw under the old rules before you get the second draw under the new rules. And generally, the old rules were more favorable than the new rules. Finally, the deadline is now May 31st. So now it's May 6th. So there's still, like 20 something days to apply. If it's something that you're interested in, I would suggest you go to your bank like this week and start to talk to them, because I'm not sure when they're going to shut down some of their portals. But basically, there is still time and there is still money in the system. So if it's something you're thinking about, you should act now. This question comes up a lot. Oh no, did I miss the forgiveness? How long do I have to apply? The actual rule from the SBA website, I put two different definitions up here, is you have until you finish paying the loan and actually to seek forgiveness. In reality, most people want to get forgiveness before their deferral period ends and they have to start to pay the loan. So you actually have to get forgiveness till the end of the loan, and you'd have to get the money back. If you're trying to do it before you have to pay, you have 10 months after the end of the covered period. So if you select an 8-week covered period, your application will be due much sooner than if you select a 24-week covered period. And if it's a period in the middle, then it's 10 months from the end of that period. So what we're finding is a lot of the first round loans maybe came out, you've spent them, your 24 weeks, September, October. So, you're talking the July timeframe. What you probably want to do is the SBA has 60 days to give forgiveness. I believe it has to get submitted to the SBA for forgiveness for the deferral period to kick in. So, just build in some time for the banks to process these loans. So, audit alert. And I know we only have a few minutes, so I'm going to go through this very quickly. But I think the question here is, did you need the funds? How'd you use the funds? And how did you qualify for the funds? So here's the loan forgiveness application. On the loan forgiveness application, you're going to have to make sure that you keep things like your bank statements, your payroll costs. If you are using rent, make sure you have a copy of the rent agreement that's dated prior to the COVID. A lot of my clients are also going the further step and taking the bank deposits or showing the payments being made so they can give the whole trail to the bank. So they're saying, here's my payroll register. Here's my check that basically says, here's my withdrawal for the payroll, so that you can basically track it all the way through. The easier you make this, the faster the loan forgiveness is going to go. We don't really need to go through the eligible costs. The second one is did you need the funds? And I really want to highlight this because the question is if current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. That's what everybody signed to when they got these loans. After the fact, these loan necessity questionnaires came out. If you have a loan over $2 million for your group, you will need to submit a loan necessity questionnaire within 10 days of submitting the application for forgiveness. So definitely complete this questionnaire prior to giving the application to the bank, because you're going to have a pretty quick turnaround time. And a lot of people are going to want to get these reviewed by their attorneys or their in-house legal counsel, because there's a lot of things that you're asserting to. There's a different questionnaire for not-for-profit and for-profit organizations. I've just shown some example things, but what's interesting here is they really drill down into what governmental orders shut you down, how much were your gross receipts this quarter over last quarter, why did you, if you suspended part of your operations, why did you suspend part of your operations? It's a really detailed questionnaire. A lot of people think it's quite unfair because this was not out when you actually had to make the assertion and you were doing it based on what you had, but this is what you're going to have to complete. There's some additional questions in the for-profit questionnaire that get more to, like, did you have employees who had COVID? Did you have to reduce the amount of employees on premises and those type of things? They get to liquidity. So they basically want to know, like, what kind of loans you have. Did you prepay any loans that were not due during the COVID-19 period? I find it really interesting. They're looking to, did you pay any employees over $250,000? So, you wonder if that begs the questions, if they feel that you should have reduced salaries. I mean, it's not written anywhere, but it is a question. They also get to, there's certain questions on healthcare services asking about COVID-19 and reduced price for services for COVID-19 and that type of thing. There's a specific healthcare section. Another question, which I just didn't highlight in there, but they also get to, if you're in a partnership structure, did you take out distributions during the year? And were those distributions for other than tax purposes? They're allowing you to take distributions for tax purposes, but they're trying to get to, like, did money get into the hands of the owners? The last part is, did you qualify? So if you qualified for the first round under the alternative size test, I definitely suggest you have those calculations very well documented. Otherwise, just make sure you have some sort of registers out there that show how many employees you have and how you feel you met it. And for gross receipts, it's a little more obvious. You're just going to look to the different gross receipts and have financial statements in order to show your reduction in gross receipts. So that basically takes us to the end of the presentation. We know that it's not the one we originally promised you because unfortunately the government didn't give us all the rules, but hopefully you were able to find some insight and some audit tips or some things that you should keep in your records or a greater understanding of some of these programs, because all this information is stuff that is still going on today. And I know there's a lot of questions out there. So, Markham would like to thank you for allowing us to present today. And obviously you have our contact information, so please feel to reach out if we can be of any assistance.
Is that I also mentioned with SciAx help. So thank you all for your patience. And oh yes, don't forget that there's a binder in the back if you need to get course credit for this by the handler. Thanks.